We're here in Monte Carlo for the Rendez-Vous de Septembre. For AMBest TV, I'm Richard Banks. And I'm joined now by Chris Methven, who's Chief Growth Officer for CyberCube. Chris, welcome.
Thank you, Richard. It's great to be here with you.
So, changing risk perceptions have rocketed cyber up the agenda. How well understood is cyber insurance?
I think cyber as a line of insurance has really matured over the last few years from its infancy, where the concern was making sure there was really enough data out there upon which to base underwriting and risk transfer decisions, to now what I would describe as its adolescence phase, where there is no other line of insurance that has as much data at its fingertips as cyber. It's how do you sort the needle in the haystack and find those signals that are really of the greatest importance. And then also on the accumulation side, as lines of business have grown, that's become an increasing area of focus, both for insurers and reinsurers themselves, but also for regulators and other market participants. And so a lot of time has been spent in CyberCube ourselves. We've spent close to $100 million over the last 5 years, really trying to identify those points of greatest value in underwriting and accumulation management decisions.
So as we see that influx of capital into the cyber market, what are the main challenges that face would-be cyber writers?
Well, the first thing I would say is we need a great deal more new capital and capacity coming into the cyber insurance market. Recent studies said that close to $1 trillion annually is lost as a result of cyber activities, which means that the industry today is covering a low single-figure percentage of that potential risk transfer opportunity. So we're certainly trying to encourage more people into the market because it's going to be required if we're not going to hit a capacity squeeze. But in terms of new market entrants, the two big things that people are most concerned about and need to wrestle with is, first of all, the attritional losses. And the story has certainly been ransomware for the last couple of years. There's evidence that as a result of the Russia-Ukraine conflict in particular, that's starting to level off. And so what that's led to is actually changes in pricing and changes in wording, which is leading to a much more long-term sustainable cyber insurance product. Secondly, people are challenged with accumulation and understanding the likelihood of some of these black swan events occurring and making sure that they're sufficiently well modeled and sufficiently allocated for.
So in terms of attracting that new capital in, what are the strategies? What's the approach?
Yeah, so there's a number. I think on the reinsurance side, it really comes down to a few things. So first of all, you have existing incumbent market participants increasing the capital that they have allocated to cyber as a line. Secondly, you have traditional reinsurance participants who have really been sat on the sidelines observing the evolution of the market. And we're certainly seeing from our own pipeline, more and more of those organizations are coming to market. The third thing we're starting to see is actually new organizations being set up specifically with a view to providing cyber reinsurance. And there's been a couple of instances of cyber reinsurance startups coming to market over the last few months. And then I think the final piece that's going to be really important in the medium to long term is going to be ILS and alternative risk transfer and the role that that has within the cyber market. To date, there's been a very few number of transactions, but we certainly see from our own activity with clients and prospective clients, the interest from capital markets and from cedents alike is increasing in terms of what that could provide as a risk transfer vehicle for cyber.
And in terms of the clients, what are their expectations of cyber insurance?
So our clients tend to be the largest insurers and reinsurance organizations. And the things that they're wrestling with is really trying to understand those attritional losses that we've touched on, and also the risk that's built up in accumulation across their book.
And in terms of accumulation, you mentioned it a few times. How well is the industry managing that, and what strategies can they put in place to better do so?
I think the industry's moved pretty significantly over the last couple of years to do a few things. First of all, modeling has improved significantly, and CyberCube's really at the forefront of driving that effort, along with our clients and partners. So I think these black swan potential events are just better understood in terms of feasibility and impact than they certainly were 2 or 3 years ago. The second thing we've seen is a real tightening up of language and specific exclusions around certain type of catastrophic risk. We're also seeing increased activity from regulators and market authorities. Lloyd's have certainly been one of the leaders in this area, but others around the world are certainly following suit, and we're seeing that in different regulatory jurisdictions. And so I think the fourth area, which is probably still emerging, is the role that governments may play. To date, we don't have a cyber catastrophe backstop in the way that we do in other lines of insurance. I think that's going to be an important part of the overall mix long term, and certainly an area of heated discussion at the moment.
So given the potential exposures from cyber, a government-backed scheme would seem to be sensible.
It would seem to be, because it is one of those it's one of those risks that truly has the potential to be systemic. In the same way that very few others do. And so I think government is going to have a role to play for those truly catastrophic systemic risks, which I just don't think the industry can deal with on its own.
So you talked about modelling, and cyber risks is an area that perhaps is less developed than catastrophe risk. Can you tell us a little bit about the process for that?
Yeah, that's certainly true. So CyberCube as a company, we've been at this for a little over 5 years now. And I would say that the way that the models have really evolved is, firstly, initially, cyber risk models were based a lot on expert judgment, and they were based a lot on extrapolating market share of different types of technologies when you were looking at a portfolio of insureds. Fast forward to where we are today, we now have many years and many, many thousands of claims against which to backtest and calibrate those models. So we're now in a much better place to be able to actually demonstrate the efficacy of our models over time. The second significant change that we've seen with regards to modeling is actually the quality of the underlying data. Again, in the early days, this was very much market share driven, whereas now we're able to provide our clients very detailed views on the digital footprints and digital supply chains of insureds. So these single points of failure that might exist across a portfolio of insureds, a particular type of technology, we can now model and demonstrate with very high fidelity across many, many thousands of organizations in an insurance portfolio.
So are people using the models that you're working on in the same way that they would use a catastrophe model?
Absolutely, absolutely. So broadly, we develop models for three different purposes, right? One is risk advisory. So we have retail brokers that are using our models every day in discussion with their clients to explain their exposure, explain how they'd look to an underwriter, and advise them on appropriate coverage and limits. The second set that we have is really focused on risk selection. It's used every day by underwriters to really distinguish a good risk from a bad risk. And then we also have catastrophe models, just as you will have seen in mature natural catastrophe markets. We have catastrophe models for up to about 30 realistic disaster scenarios that we've determined for cyber cat loss.
Chris, thank you very much indeed for joining us on AM Best TV.
It's been a pleasure, Richard. Thank you for having me.
For AM Best TV, I'm Richard Banks.